Friends, I welcome you to this session on issue of shares. As we have discussed in the previous video about joint stock company and company accounts in general, and we had discussed in detail about the stages in formation of company. As you know, first step was promotion of a company where promoters play their role in establishing the company. Second one is a registration or incorporation as per the provisions of Companies Act 2013, and after obtainment of certificate of incorporation, joint stock company is allowed to issue shares. As you know, share is a share in the share capital of the company. Before discussing about the issue of shares and types of shares, let us know something about share capital. You know, share capital is nothing but capital raised through the issue of shares. The capital is the money required to start and run a business, which is required for in long term is called as fixed capital, and to cover the running and maintenance expense we call it as a working capital. And this share capital is the joint stock raised or contributed by the shareholders. As you know, all shareholders are owners in case of company. A share capital is the amount of capital required, and that maximum amount which a company is empowered or authorized to raise must be mentioned in the capital clause of memorandum of association, which I have explained in previous video. That capital which is authorized to raise by a joint company is called authorized capital. This authorized capital is also called as a nominal capital because it is only namaka vast, only in name, and it is also called as a registered capital because capital with which company will be registered with the registrar of company. Usually company may not issue entire authorized capital, part of which will be issued, means offer to the public for their subscription is called as issued capital. So issued capital is that part of authorized capital issued to the public for their contribution or subscription. Issued capital may or may not be fully subscribed. That amount of capital which is demanded or promised to be contributed by the public is called subscribed capital. The company may get full subscription or sometimes under subscription or even over subscription. In case of over subscription, company can't allot shares beyond the number of shares issued. So maximum of subscribed capital will be limited to issued capital. In case of under subscription, the amount of subscribed capital may be less than issued capital. And company when raises capital may not require entire amount of capital at one space. So it may decide to call, issue and ask the shareholders to contribute at different stages, like some amount on application and some amount on allotment, and balance in the future whenever company is in need will make a call. It is called as a call, share call. So that part of share capital promised by the public, that is subscribed capital, which is called by the company to be contributed is called up capital. So called up capital is the amount of capital which is the company called the public or shareholders now to pay the amount. When this capital is called, shareholders being owners may or may not contribute in full. Sometimes that may be default of non-payment of call money or allotment money by the allotted shareholders. That amount which is called to pay but not paid are called calls in arrears. So called up capital less calls in arrears equal to paid up capital. Sometimes company against non-payment of call money, when there is a default, defaulting shareholders will be asked to pay that money, and proper steps will be followed. In spite of all this reminder, if defaulting shareholder fail to pay, that amount will be forfeited, or that amount of capital which is already paid on the defaulting shares will be called will be forfeited, called forfeited shares account, because that amount already paid on these defaulting shares by the shareholder is a profit of company. So sometimes paid up capital will be called up capital less call scenarios add forfeited shares. So this is the amount of paid up capital which is available to the company for its purpose of capital. Hence, in every case, paid up capital will be considered as a final amount of capital in the balance sheet. Now we shall discuss the meaning of shares. As name says, share means share is a share in the share capital of the company. It means the total share capital will be subdivided into certain units of equal value or equal face value called shares. Say for example, if company's authorized capital is 10 crore, it may decide to issue shares of 10 each. Then 10 crore divided by 10 means 1 crore shares will be the authorized. Then it depends upon its requirement, it will issue part. So share is a smaller unit of capital, and company can issue shares in different form. Basically two forms, like preference shares and equity shares. A preference shares, as name says, a category of shareholders will have a preferential rights over other types of shares. Preference shares are those shares which has preferential rights as regards the right to dividend and repayment of capital in the event of winding up of company. In other words, preference shareholders are those shareholders who has preferential right over equity shareholders as regards receipt of dividend as well as repayment of capital. These preference shares can be of different forms based on the need and nature of the company. On the basis of accumulation of right to profit, preference shares can be classified as cumulative preference shares or non-cumulative preference shares. Cumulative preference shares are those shares where arrears of dividend accumulates. Say for example, in 1 year if there is a loss or profit is insufficient to pay dividend, in next year profit first that arrears of dividend will be paid and then next year's preference dividend. After that the balance will be used for equity dividend. So cumulative preference shares are those shares where there is a right to accumulate the dividend, arrears of dividend, and non-cumulative preference shares are that category where there is no such right of accumulation of arrears, and participating and non-participating on the basis of participation in the excess profit. As you know, fixed shareholders will get fixed rate of dividend before equity shares. In case of participating preference shares, they will get fixed dividend first, then good dividend will be given to equity. Out of the balance left after payment of equity dividend, this preference shareholders will have a right to take part or share in that profit. And non-participating preference shares are those who does not have such a right to take part in the excess profit after payment of their fixed dividend and equity dividend. And convertible preference shares are those which shares can be converted into equity after the expiry of fixed period for which those shares are issued. Say for example, if preference shares are issued for 5 years and the expiry of 5 years, they will be automatically converted to equity. Once they are converted into equity, they get the equity shareholders rights or status. And that type of preference shares where there is no right of conversion into equity are called non-convertible equity shares. Then unlike equity shares, preference shares has to be refunded or given back or redeemed. All those preference shares which are redeemable on the expiry of fixed period for which they are issued are called redeemable preference shares, and those preference shares which do not have such a right of redemption are called irredeemable preference shares. But now as per the existing law, all preference shares must be redeemable. It means preference shares must be redeemed or repaid on the expiry of a fixed period for which they are issued. Next category is equity shares. Equity shares are also called as ordinary shares. Equity shareholders are real owners of shareholders, and equity share capital is that capital is raised through the issue of equity shares are called as a risk capital, because equity shareholders are having a right to receive dividend at the end. They are standing at the lowest level of corporate dividend distribution hierarchy. They get share only after paying preference shareholders dividend. If there is a profit they get, there is no question of accumulation. Only in the year when there is a profit for their dividend they get. Then another category is a deferred shares. Deferred shares are those shares more or less equal to equity shareholders, where only private companies can issue them, where there is a deferring of payment of dividend. Next, modes of issue. Shares which are issued now, it is through book building process. When shares are issued at a face value are called as a issue at par. When shares are issued at a price higher than the face value, then it is called as issue at a premium. Then if shares are issued at a value less than face value are called issue at a discount. In case when there is a good prosperity, company will normally go for issue at a premium. Now through the book building process, this mode of will be decided. When equity shares, say total share capital divided by a number of equity share, you will get a face value of shares if it is 10 rupee. If 10 rupee shares are issued at a rupees 10, that is called at a par. Both share capital on the liability side will be shown at 10 rupee, and a bank account, that's the amount received, will be shown on the asset side at 10 rupee. When shares are issued at a premium, in the sense 10 rupee shares if issued at 12 rupee, that 2 rupee excess is a profit, that is capital profit, should be separately shown as securities premium account on the liability side of balance sheet. So 10 rupee equity share capital, 10 rupee security premium on the liability side, and 12 rupee bank received on the right side. Then issued discount is a loss, capital loss. Say when 10 rupee shares are issued at 8 rupees, no doubt on liability side share capital is shown at 10 rupee, and on the asset side bank account at 8 rupee, and discount on issue of shares, that is a capital loss, should be shown as a fictitious asset on the balance sheet at 2 rupees. And we shall discuss about these while solving a problem in the future classes. Thank you.